Prada, the global luxury brand, is listed in Hong Kong. In the early 2010s, the brand was very profitable and grew rapidly as it expanded into China. However, since 2016, life has been tougher and both revenue and margins have declined. Last year, Prada launched a turnaround story based on the rebuilding of the brand's exclusivity, and since then the stock has rallied. It caught our attention because, although the stock is up, Prada still scores very badly on our governance, accounting and peer performance metrics. Having reviewed the accounts and recent announcements in detail, we think management may have its own agenda and minorities could be in for a very rough ride. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. Governance. The family owns 80% of the equity, and despite the company's decline, they continue to pay themselves quite generously. Apparently there is some relationship between pay and performance, but it isn't obvious and there's no disclosure on it. The family is also able to extract further benefit from the Lisco thanks to multiple related party deals with connected companies. A good example of this is the recent acquisition of Fratelli. Fratelli is a retail company owned by the CEOs that only sold Prada product. In the past, this meant that the family was able to privately profit from the relationship with Prada, but over the last couple of years, revenue has fallen dramatically and Fratelli lost money. Last year, it appears the family decided enough was enough, so they sold Fratelli to Prada for €66 million. This is the equivalent of 1.5 times sales and over 4 times book. Pretty attractive for a business in decline. Given that both CEOs are now over 70, we worry that this is just the start of a series of cash extraction deals as the family starts to clean up their group by offloading other businesses into Prada at somewhat more attractive prices than you'd expect. Performance. Prada's revenue has fallen, but Prada's gross margins have held up quite well, and they remain in line with its luxury peers. It's not obvious that discounting is the problem it's perceived to be. In contrast, it's very clear that operating costs as a percentage of revenue have ballooned, and this is why operating margins have halved. When we look at store and staff productivity, it's clear that it's down about 30%, and it's hard to see how margins will recover unless this can be reversed, and we expect this to take quite a long time and require significant investment. The difficulty is that Prada is already levered and may struggle to fund any future investment without cutting the dividend. This is probably going to be hard to do because it provides the family of cash flow and is also unlikely to be good news for the stock price. To understand how this has happened, we need to dig into their accounting. Prada has maintained a very high payout ratio and dividends to its shareholders nearly all of its profits. That would be fine, except reported profit is so much higher than cash generation. As such, the dividends effectively hollow out the company's balance sheet. And this is why Prada has gone from being net cash in FY 2013 to a €500 million net debt position today. There are two key reasons for cash generation being so low. The first is that CapEx is nearly always higher than depreciation, even though this extra growth investment achieves very little growth. This would suggest that their depreciation rates are simply too low and profits are being inflated. The second reason is that their inventory levels continue to rise year after year. Prada has a new excuse every year, but the reality is current inventory levels are very high when compared to either their own history or their peers. We also worry about the fact their provisioning for obsolescence is falling. Both of these practices result in profits exceeding cash flow, and so the high payout ratio means that Prada is effectively being stripped of the capital it needs to survive. Before you go, please remember, none of this should be taken as investment advice. We've sourced our facts from the company documents, but the interpretation and conclusions are just our opinion, and of course they are subjective. If you want to dig into some of the issues we've covered, please visit our website and have a look at the Prada page using the links below. There you can download some of their recent filings where we've highlighted some of the key areas. Alternatively, to learn more about our research or to keep up to date with our reviews, please subscribe to our channel or send us an email. Thank you very much for your time.